Our next discussion is on the Nedgroup Investments Balanced Fund, managed by Truffle Asset Management. The fund has a very strong long-term pedigree, with the fund ranked first against peers since inception in November 2011. That long-term track record is particularly important and relevant in today's markets, where balanced funds are being asked to do a lot more: participate in growth, manage downside risk, and navigate volatility across local and global assets, as well as making sensible long-term asset allocation decisions. Saul, maybe just to start with, despite the volatility we've seen in SA assets, we know equities are down negative year to date. The fund's still delivering positive and healthy returns. Maybe just walk us through maybe the quarter and the 12-month performance of the fund.
Sure. So in terms of our offshore equity exposure, we've had quite a bit of exposure to the semiconductor sector, in particular memory, but we've also had some exposure to TSMC and ASML, but our biggest exposure has been in the likes of Samsung. That sector's done particularly well, so that has helped both our 3-month and our 12-month performance. It's a sector that we've actually cut very aggressively recently, but we can talk a little bit more about that later on. In terms of the 1-year performance, PGMs and gold have done nicely for us, but on a 3-month view, that has hurt us. So we have been pulling that back a little bit, but we still have some exposure, and that's why you'll see it hurting the shorter term. In terms of some of the negatives, I'd say Naspers and Prosus has detracted quite a bit on a 1-year and on a 3-month basis. It's the underlying share there is obviously Tencent, and we still like Tencent, and it's actually a share that we've been buying into weakness. So it's also a share we can discuss a little bit later in the presentation as to why we've continued to buy that into weakness. So although it's painful in the short term, we think it will pay dividends in the longer term.
I want to move now. Firstly, there's a lot to discuss the way the portfolio is positioned, but looking at sort of the bigger picture themes first. Looking at global growth, the US has remained resilient. We know part of that reason is due to the AI build-out, lots of capex spend going on. How do you think about the AI capex cycle? Is this still a durable productivity story, or are there parts of the market that's beginning to discount maybe a bit too much?
So I certainly think the economy will ultimately benefit from AI, just as economies have benefited from new technologies through the ages. It's just which companies benefit and suffer. Often a lot of the companies involved in a new technology aren't the ones of at least the medium to long term. They're not necessarily the ones that benefit. Sometimes it's the users of that technology. So if we look currently, what are we worried about? And we are getting a little bit more concerned about the size of capex spend in the US economy. It's obviously the largest capex spend that's ever been, but it's important to remember that tech capex as a percentage of capex grows over time. So capex, the contribution from capex to overall GDP is quite volatile, but it's fairly stable, as you can see as in it mean reverts over time, and that's what you can see in the chart. And you can see that from the chart, you can see that tech capex also rises as a percent of GDP over time. But even given that, it is still very elevated. So it almost looks as elevated, if not more elevated, than it was during the tech bubble of 2000. So we are worried about too much going in here. And why does that matter? Well, if you look at what happens in recessions, which are highlighted by the dotted green lines, you'll see what tends to go down most aggressively in a recession is capex. Now, sometimes it's coincident, sometimes it might lead the recession, but the point is that during the recession, it goes down aggressively. So if there has been a dramatic amount of capex spend, the risk of a bigger pull down is obviously higher, and the risk of that filtering through to the greater economy obviously has consequences. It has consequences for companies that aren't just involved in AI, but it has consequences for companies like Caterpillar that would be involved in building data centers. So we worry about a hit to the overall US economy. Why are we worried about, why are we starting to worry more about this issue around capex being too high? Well, if we look at the stack of AI, you've got the LLMs, you've got the data centers that host those LLMs, and then you've got the semiconductors that provide the hardware for those data centers, the chips. The worry is that when you look at this chart, you'll see that the revenue and profits all sits at the bottom. It sits with the semiconductor players. I mean, we haven't even included the memory guys here. They obviously are taking an enormous portion of profits. And you can hear by the sort of anecdotal stories of bonuses that staff at Samsung would be getting. It's just, the numbers are enormous. So there's no sort of, the distribution of revenue and profit is very lopsided. Something's going to have to change here. I mean, maybe you do get this explosive revenue suddenly coming through and it covers the costs for the data centers and the LLMs, but we worry that the risk to that thesis is changing quite rapidly. I mean, why do we worry about that? Well, if you look at the efficiency of the models, or the open weight models that are competing with some of the frontier models, like and when I say frontier models, the likes of OpenAI and Anthropic and so on, we can see that gap is closing very, very rapidly. So the ability to charge, and they're charging quite a lot for these tokens, there's obviously a lot of pressure. As you probably know, token prices are falling, so you've got prices coming down. The second problem that you have is that the market share as a result for these frontier models is also dropping. Just, if we look at one example here, where we're looking at an aggregator of AI, and you can see, or of large language models, you can see that the market share within the space of a year has essentially halved, which is a very, very short time for a halving of market share. So you've got pressure on volumes, you've got pressure on price. I mean, volumes are still growing, but they're not growing necessarily at the rate that was expected. So this is obviously a huge worry for these companies, and you can see it manifesting in the likes of an OpenAI delaying their listing. And we think that sort of, the bell, I wouldn't say it's the final bell that's being rung, but you're getting some signs that are certainly worrying, that some of these companies might not be sustainable given the changes that we're seeing. And then if you do have one of these companies losing funding or shutting down, that obviously ripples through the chain. It ripples through the companies that host these data centers, and eventually, if you have to pull back on capex, it ripples through to the semiconductor players.
Yeah, and I think we're starting to see that playing out in markets now with these questions around the return on investments, right? We look at the hyperscalers, year-to-date performance, even more recently, semiconductor stocks, right, where they're starting to actually pull back a bit. That's coming off the boil. In your view, where do you see the future economics accruing to? I think what I'm getting from you, it's not going to be, the LLMs themselves, but perhaps a layer above them or below them.
Well, I think where the opportunity should be is, I think some of these hyperscalers that have come down in valuation, we're talking about the likes of an Amazon and a Meta and a Microsoft and so on. A lot of these companies have had their cash flows coming under huge pressure because of the spend. If the spend gets throttled back, their free cash flow yields and free cash flow generation should rise quite aggressively. So over a medium term, they should actually benefit if this capex gets pulled back. As it happens, as we go into, when this event happens and we get these sudden reductions in capex, it might be negative for some of these hyperscalers. You've got Microsoft that has a stake in OpenAI. They've obviously got contracts with these LLMs. So some of them might actually take a bit of pain, but over the medium term, I think they would probably be beneficiaries, some more than others.
Okay, so some opportunity there still. Definitely. Yeah. I think, turning to the physical world now, you mentioned, you've been hurt by PGMs in the short term, other metals not doing as well, but copper seems to have been relatively well behaved. Part of that is due to the AI build-out, where we're getting sort of new sources of demand. Beyond that, what makes copper particularly compelling relative to other commodities at this point in time?
Sure. So I mean, the demand, as you mentioned, it's needed for data centers. It's needed in renewables. It goes into EVs. So there's quite a lot of demand for copper going forward. The other issue with copper is the supply side, and we just don't have any new discoveries. The costs keep on rising. So that obviously means you've got this rising demand. This inadequate supply means you have deficits. So That means higher copper prices over time, which obviously presents an opportunity in some of the miners. I mean, one of the things we have to be a little bit careful of is, I think there is a speculative element in copper that's probably running on the back of some of this AI frenzy. And not all of it, I suspect, is fundamental. So I suspect there is some investment that's linked to that. And should that roll over, you could see a bit of pressure in the copper prices. That's probably more of a short-term concern, but it is something that's important to highlight. I think in the medium to longer term, we still should see these deficits being positive for copper prices.
Okay, now how are you capitalizing on this theme? What's your preferred play into the space?
So there are essentially two reasonably direct plays. When I say reasonably, one of them is very direct, which is Anglo's, where over 3/4 of their profits, once this deal is done with tech, over 3/4 of their profits will be copper. So they essentially become like a copper miner, should be priced like a copper miner, and they are a high quality, they will be a high quality copper miner in terms of where they lie on the cost curve, in terms of the volumes that they can still produce. So, to the extent that they re-rate to some of the top copper company valuations, there's quite a bit of upside in Anglo's, but I'd say a lot of the top copper companies are probably on elevated valuation, so it's worthwhile bearing that in mind. If we look at the likes of a Glencore, we think that is a cheaper way to get exposure to copper. It's not sort of their copper exposure is less, but it is still very significantly, as you can see from the slide, it's the largest contributor to Glencore's value comes from copper. We don't think that's being priced appropriately when you do a sort of sum of the parts for Glencore. Should we get a deal in Glencore, I think you could get a realization of that value, which would give you quite a lot of upside from the current level. Quite possibly with a lot of the volatility that we've seen in commodity markets, there also might be some sizable profits that come from Glencore's trading division, much like what you've seen with those divisions of some of the foreign banks that have been producing results. So we could see a nice benefit there as well in Glencore, which is why I suppose it's the cherry on top for why we like Glencore. Most of it would be an unlock of the copper value.
Thanks, Saul. Just to move away from the AI theme a bit, the fund has benefited from defense exposure over the last 2 years. I know you've pulled some of it back. If we sit back, fast forward 5 years from now, could the defense sector end up being as important as perhaps the tech sector over the last decade? I mean, we know there's increased budget for it, particularly in Europe, elevated geopolitical uncertainty, increasing wars as we've seen. What are your thoughts on defense going forward?
So defense has done very well. I mean, we've seen a huge re-rating in the sector from the very pedestrian ratings that it used to have. We do think there is still runway for defense shares, and that's kind of highlighted by this chart where you can see that current defense spend for NATO as a percentage of GDP is a little bit over 2%. Now, I mean, their targets are for 3.5%. We're not suggesting it necessarily gets to that level. There's some countries that have got budgetary constraints, so they won't necessarily get to that level, but you should be able to get to 3%. And if you go from sort of, let's say, 2.2 to 3% up until 2035, it means you have got an increase in tech spend for quite some time. Another benefit that these tech companies will also get is they need to source more domestically from Europe and less from the US, as that relationship obviously becomes a little bit more complicated. That is another factor that will drive defense company revenues in Europe. So I mean, we can sort of see revenue growth we can see teens revenue growth for a lot of defense companies for the next few years. That will obviously give rise to slightly higher profit growth. So I'm talking averages here, but if you sort of look at a roughly a 20 PE for some of the defense companies that we own, and you're getting 20% earnings growth for at least the next couple of years, and they're not falling off either because you're obviously increasing this, we think they look reasonable. So certainly not as cheap as they were, which is why we have been taking profits. Some of them got very expensive, which we sold out of completely, but we certainly still see reasonable opportunity.
So definitely, some runway left, at least for the next few years. Yep. Bringing the discussion closer to home now, I want to get your thoughts on SA assets. We've seen inflation targeting come through to improve fiscal dynamics. We know there's lots of growth challenges. What's supporting your case for SA assets today?
Okay, so we are We're a little bit less optimistic about SA today than we were at the beginning of the year, but there are certain aspects of SA that we're still positive on, and that's really the valuation piece. So what sort of gives you a reasonable rating or a PE ratio. We think that should be sustainable. So I mean, one of the reasons why we like that is due to the fact that we do still have a reasonable terms of trade. So given where precious metals are, given where oil prices are, that could obviously change, but currently we're still in a reasonable position at spot. Using current prices, we're still better than where we were a year ago. If we look at our budget deficit projections or budget surpluses, we still are generating, it looks like we will continue to generate primary surpluses, and I think that's hugely positive, and that's probably what's helped drive things like some credit upgrades that we've seen from some of the rating agencies. Inflation targeting seems credible at this stage. We've obviously got a very credible Reserve Bank, so one would take them quite seriously. If they want to target inflation, they are presumably going to maintain this reasonably tight monetary policy. It's not necessarily good for growth, but it's probably good for rates and for bond rates. So I think what we will see is we'll see bonds which have done very well to date, as in yields have come in. We think those yields can probably hold where they are. We don't see a lot of room for further compression. There are different ways of carving up the bond yields. This is one way that we do it, which we're showing on the chart here. You can see we build it up from a US real yield. We then add a credit spread or sovereign, for SA's sovereign credit risk, and then we add on an implied inflation, an implied SA inflation. And you can see US real yield sitting at about 2.3. We don't see that coming in we don't see that coming in a lot, given the sort of pressures and given the debt issuance in the UA. We think that's elevated. If you do get this collapse in capex and a recession, of course that would come down, but putting that aside for the moment, that probably remains where it is. We have had a win in terms of our credit spreads compressing, so that has moved meaningfully in our favor, and the same goes for our implied inflation rates. They've come in a lot from where they used to be. They're sitting at about 4. It's not like they're ever going to go to 3. There has to be some element of risk priced in there. So bonds reasonably compressed, which is obviously good for our valuations. When it comes to growth, the piece that drives the earnings, you obviously get your uplift in share prices from PEs and earnings. The PEs are all right. It's the earnings piece that we worry about. And if we look at the economy, the local economy, I mean, one of the things we look at are things like the number of people employed. That is certainly not, that's if we use Stat SA numbers in the chart, you can see that if we include the informal sector, that's fairly flattish. The formal sector is actually going backwards. So we certainly worry about growth in SA, and we worry about certain sector-specific issues as well. If we think about in retail, you've obviously got more competition from outside of SA. That obviously weighs on us. So there are other factors that are also weighing on the earnings prospects for SA. So we're quite picky in terms of what we go for in SA. We don't just want to buy everything, because we certainly worry about negative earnings revisions, which will swamp the cheapness that you see, and that's what we've seen in certain sectors.
Yeah.
That's been a far more important factor in terms of driving share prices.
I want to come back onto that selectiveness in a minute. I just want to touch on, one of the challenges you mentioned is growth and employment, obviously a big part of that. How cautious are you on consumer-facing businesses at this point?
Sure. So if we look at clothing retail, we're particularly worried there. If you look at what some of the offshore guys that have come into our market, if you look at the likes of a Temu or a Shein, the pricing, the aggressiveness of their pricing is very extreme, even relative to our cheapest retailers, on some using samples of a basket of clothing that most people would buy. If you look at the chart, you can see just how cheap a Shein shows up relative to our SA clothing retailers. So that is a worry. So far, that does not seem to be a trend that is going away. We've got Amazon Prime now launching, which looks very affordable. It caused quite a bit of damage in the UK. Not saying it'll be as severe in SA, but it's just another headwind. So it's pretty tough to generate decent turnover growth if you're not getting any inflation You're not getting much volume growth, and now you're not getting much inflation. That is obviously a worry for the clothing retailers. So we're generally quite wary of them. PEP was an exception. We kind of felt that there are other drivers other than just clothing in PEP that'll help drive earnings growth. So that's why we've liked that particular share. But otherwise, we've been fairly underweight. We've liked some of the food retailers. Some of them have derated quite a bit, like a ShopRite. So we felt that was offering value. We think towards the end of the year, they should probably get a benefit from El Nino, which could drive some food price inflation. At the moment, it's actually the very opposite of that. We've got very little inflation. They could almost be in for a bit of a tough quarter or two, but if we look further out, they should probably get some help. And with their lower multiples or more reasonable multiples, there's probably more opportunity there.
Coming back on, you've touched on it, on where you're being selective. What are some of the other opportunities you're seeing in the SA market?
So I'd say the sector that we like most in SA at the moment is actually the dual listeds and the offshore exposed counters. So the likes of that I mentioned earlier, Prosus and Naspers is something that has really hurt us over the last year. It's kind of been the anti-AI trade. They haven't been in the sexy part of AI, and they've actually been punished for it. I think that's been a bit unfair. We still think it's a fantastic business. If you look at Tencent, it's trading on a very low double-digit multiple, yet the core business can probably grow at in the sort of mid-teens. So we think that's a fantastic opportunity. So we've actually been upping our exposure there quite significantly. There are other examples of dual listeds, or even if they're not dual listeds, they are primarily exposed to offshore and not to SA. Bidcorp would be another example of that. It's very much exposed to the developed world. It's a great business trading on about a 15 PE with reasonable growth prospects with no debt. This is a business that could do a meaningful acquisition at some stage, which would probably be very value accretive. So we like that. We've also liked Anheuser as well. It's also, I think, offering reasonable value, should produce reasonable growth, probably better than a lot of SA companies. So that's really the area where we found the most opportunity in SA at the moment.
Okay, maybe on that note, maybe give us your view on the portfolio overall. I know you've got an element of protection in the portfolio. This particular period, let's call it the last 6 months, has been tough to navigate, from a multi-asset perspective, maybe perhaps frustrating at some points, but there have been pockets of opportunity. Maybe just give us a view of how you position going forward.
So currently, our physical equity is sitting at about 65%. We have put in quite a few hedges, so the net effect of that takes us down to 60. Those hedges are essentially collars, mostly on the S&P and some on the world market. We can still benefit if markets run by sort of 8% from here. Above that, we would obviously start losing out, and that's how we pay for the protection. Similarly, if markets fall by 8%, we would get more protection in the portfolio. And we think that's appropriate given the cost of those collars has not been too expensive. We think there are risks building in terms of capex that I've mentioned. There's still quite a lot of uncertainty around what's happening in the Hormuz Strait. I mean, that's something we haven't spoken about, but that is always a sort of tail risk that we get a hike up in oil prices if something happens there. So that there's obviously a bit of protection against that type of risk. In terms of our offshore positioning, it is fairly high. It's at 43%. I think that's appropriate. The Rand has done well, not suggesting that the Rand's necessarily going to weaken, but I think a lot of its strength has already been done. So I think it's appropriate to make use of offshore for diversification purposes. If we move into maybe a little bit more granular detail, if we look at the SA piece, as I said, it's the foreign JSE exposed shares, the likes of your Naspers and Prosus and Bidcorp and Anheuser and so on, that you'll see as the largest contributor. Obviously tying into what I mentioned earlier, we have cut back. If we go back to the beginning of the year, we have reduced in the likes of our mining space. We've pulled back precious metals a little bit, and we've also pulled back on financials, which have also kind of re-rated to fair long run multiples. So they're not expensive, but they're certainly not as cheap as they were. If we look at foreign, one of the big changes in our foreign portfolio has been semiconductors. It actually doesn't even show up here. It used to be one of the largest contributors to foreign. We've mostly sold out of that in the last month, for all the reasons that I mentioned earlier, that we're getting a little bit more worry, particularly around the froth of semiconductors. We still have quite a bit of exposure to defense. As you can see, it is less, but for the reasons that I spoke about. We still quite like banks in Europe. There's quite a bit of exposure there to Greece. Greece is actually growing at a much better rate than a lot of your developed European countries. We still see quite a lot of runway there. Their banks are very cheap. We expect to get double-digit returns from those banks over time. A lot of them have really fixed themselves up. They're generating good returns on capital. And then for the rest of offshore, it's fairly spread across different sectors. You'll see U.S. healthcare also shows up. That's a sector that had underperformed quite dramatically over last year, and we made use of that underperformance to get a position in that space.
Thanks, Saul. I think we'll leave it there for now. That was very insightful. We appreciate your time, and we look forward to some more healthy returns over the coming quarters and the coming periods. Thanks so much.
Thanks for having me.